Oh, hello everyone. Hello to everyone here in London and to our very large online audience. I'm Sara Pantuliano. I'm the Chief Executive at ODI, and I'm really delighted to have with us Dante Disparte, the Chief, I'm going to have to get your title right, Chief Strategy Officer and Head of Global Policy at Circle. Thank you so much for joining us
Thank you, Sarah.
tonight.
It's great to be here.
So Dante and I have been sort of bumping into each other for a few years in the context of various, global meetings and events focused on the potential, the opportunity of digital currencies and cryptocurrency in particular. As you know, ODI does a lot of work on this. The current global financial system faces significant challenges and has left billions of people unbanked, struggling to get access to essential financial services. And all of us have been struggling to think about new solutions, new ideas, new ways of reaching people that can have access to the banking system. This is a big problem in low and middle income countries, but Dante and I were just chatting about it. It's not just there. If you think about, how many poor people in rich societies also struggle to have access to the banking systems. And so cryptocurrency and stable coins like USDC that is issued by Circle, and we'll go in detail into that so we can all understand better how this works, offer this promise of a faster, freer, fairer system for billions of people that are excluded. So I saw Dante in New York during the UN General Assembly, and I thought, I heard he was coming to London, and I thought, what a great opportunity to actually bring you in, ask you a few questions about this incredible promise, that sort of Circle's journey has been, and really trying to understand this evolving sector, this rapidly evolving sector, what the opportunity really is, what the challenges are, understand the issues that pertain to regulation, understand some of the skepticism that is out there. I thought, who better than you to help all of us, navigate this relatively new territory. So I'll ask Dante a few questions around all of these issues that have been discussed a lot at ODI, as in many other circles. But then I'll give everyone an opportunity to ask Dante the question, and particularly the online audience. I'll be getting your questions and putting them to Dante. I'll try to touch on all the issues that over the past few years I have definitely had conversations about, struggled with, challenged people about. And we can have a conversation about the different perspectives that we may have. But I'm really excited to have you here to really talk about all of these issues. You have a unique perspective on them, a deep understanding, and can really help navigate, this digital asset landscape, and see if we can really move what has been a lot of piloting and experimenting to the scale that we need to achieve transformative change. But let's get started.
All right.
So we've been talking for a long time in several circles about how cryptocurrency can create greater financial inclusion. So we know from the latest figures from the World Bank that almost all adults without access to a bank account live in low and middle income countries. So what can you tell us about the potential of cryptocurrency for the unbanked?
Yeah. Well, first of all, it is a real pleasure to be with you, Sarah, and to be in the ODI Inner Sanctum finally. This is the capstone of my state visit to the United Kingdom. And as I recently said publicly in observing the changes in the UK, you can't have the economy of the future unless you have the money of the future. But in order to really stay true to the conversation and also to frame the conversation in the context of humanitarian work and financial inclusion work, we got to start with understanding the problem statement. So if the first of the Sustainable Development Goals is the eradication of extreme poverty, but yet if to be banked requires a couple of critical things. It's not me, it's the policy environment setting these issues. Number one, we have more than 1 billion people in the world who don't have a form of a nationally issued ID that would get them onto the bottom rung of the formal economy. The problem statement. The second is if to be banked hinges on brick and mortar, then we will realize how much our traditional economy has hit a point of diminishing returns. And so assume that even very well-intentioned, very large banks and financial institutions want to reach people in sub-Saharan Africa, developing and emerging countries, or even give you and me access to our money beyond banking hours and weekends because your financial needs don't take a bank holiday,
Yes.
then it begs the question, how are we going to do any of these things but for digital transformation of not only money, but the delivery of money in a responsible manner to the last mile? So I think that's the problem statement. We then have a couple of other problem statements, and then hopefully in the conversation we could help resolve them. The second is the post 9/11 global financial crime compliance framework presumes guilt before innocence. And so if you're living south of the equator, you live in a banking environment in which the fear of one person making one bad payment fundamentally locks people out of the formal economy. And so there too is another very big policy conundrum. And one of the reasons before Circle, I was one of the founders of the Libra project. One of the reasons I joined that project, and if you read anything that I wrote about big tech before that project, you would realize I wasn't a fan of large platforms like Facebook. Was my calculus personally was win, lose, or draw, the project would change the arc of the conversation, because now you had a body and a group of actors that could work at scale and challenge some pretty entrenched monopolies and duopolies for the movement of money at global scale. Even a country like the United Kingdom is at the mercy of very few major payments operators in terms of how the UK economy works and where you could execute a payment. And so I joined the project knowing that even in failure, at least we could be honest about the global financial exclusion issue that is a reality for so many people. So then fast forward to today. I left Libra, wrote its obituary, joined Circle, and obviously Circle was a company that is an 11-year-old firm, a firm that didn't ignore the regulatory requirements in the industry and had put in motion this digital dollar known as USDC, which was regulated, which was liquid, which was not internet funny money, but as an innovation was trying to solve what I call crypto's original sin, which is that the notion is great and noble and right, that we could have an internet of value in which any internet connected device anywhere in the world could be a payment endpoint. But if what you're sending people as money is little more than vaporware and not convertible and not usable in the real economy, then you're sending people a liability and not an asset. And so in 5 years, USDC went from 0 to availability in 190 countries and counting. And what we're now trying to do deliberately at Circle is to ensure that the value chain and that all of the dots are connected so that there's a payment endpoint for anyone who could reach it for little more than a basic mobile device.
So for people that are not familiar with cryptocurrency and Circle, can you explain the difference between USDC and other stablecoins, for example, Tether?
Sure.
Because we have a lot of people that are really interested in this space, but don't really know.
Well, it's let me describe what a stablecoin is supposed to be, and then we could describe how they're increasingly regulated around the world. The word says it all, right? Bitcoin as an innovation was a critical innovation in launching this wave of blockchain-based financial services. But where Bitcoin fell short as a payment innovation was in hypervolatility. No one would buy pizza, and actually there's something called Bitcoin Pizza Day, with an asset that would end up, costing you more the morning after. And so in looking at what stablecoins are supposed to do, they're supposed to provide a stable digital unit of account, medium of exchange, and store of value. The 3 properties of money are those 3. But the part where money falls short is, of course, its lack of transmissibility as a medium of exchange. So cash is a great innovation for financial privacy, for settling private payments, but it's a horrible innovation if you want to transmit cash at the scale of the internet. So a stablecoin is meant to hold its value at par to an underlying reference currency, but then to have the transmissibility of the internet on top of it.
So it's in a way, there's been obviously all this optimism and buzz, but the stablecoin is trying to deal with what we've also seen in terms of the volatility and, of course, the controversy that has accompanied a lot of cryptocurrency in recent years. And I think that is some of what is still not immediately obvious, to many, and there's a lot of concerns about the risk to consumers in particular. So what would you say to reassure consumers?
Yeah, so this is such an important conversation. And again, I want to frame it in the context of work to be done and unfinished work. People spend a lot of time talking about the consumer protection risks of what happens if digital assets get big. What happens if stable coins become ubiquitous? What happens if people lose money by betting or speculating in these innovations in the first place? But not enough questions have been asked, and I've been in every meeting everywhere in the world, public and private, about what are the risks if we do nothing? What are the risks of a financial system with 1 billion and more people locked out permanently? What are the risks of a wealth generation system that presumes you have wealth in the first place in order to, make money? To be a qualified investor in Wall Street, you need $250,000. So we've basically built the two pillars of making money and saving money and having payments all presume that you're banked and all presume that you're wealthy. So that doesn't mean, though, that crypto should get away with its checkered scorecard, right? Crypto is no more monolithic than banks are, and no more monolithic than public money. 50% of the world's adult population has a domestic currency environment that's hyperinflationary. And in some countries, the money may not be worth it, the paper it's printed on. But in crypto, there have been many vaporware projects. Famous Terra Luna collapsed $60 billion over the span of a weekend. So the key is not all stablecoins are created equal, not all money is created equal, not all banks are created equal. And increasingly, more and more countries around the world are actually regulating the innovation and bringing it onshore, which could only produce net positives for the planet.
Yeah. Well, let's talk about some of the countries there have adopted, for instance, Bitcoin as a legal tender. El Salvador in 2021. That drew a lot of criticism, particularly around the threat to government monetary policy because of the Bitcoin volatility, but also because of the environmental impact of, sort of linked to minting Bitcoin. We've seen the IMF recently recommending strengthening the regulatory framework and the oversight of the Bitcoin system in Salvador. How do you see this? What role do you think regulation should play in relation to stable coins and other cryptocurrency, especially in emerging markets?
Yeah.
That's something we've discussed together with other people many times.
Yeah, well, look, it's also somewhat of a complex question because it's, how do countries, one, escape the long arm of dollarization is one part of the discussion. Yeah. While at the same time, how do we ensure that any country is accountable to its citizens for the failure of monetary policy and economic development? And so it's an incredibly complex piece of the puzzle. And in my view, watch what they do, not what they say. If you're a developing country central banker and you're watching the rest of the world, frankly, all of Europe has brought digital assets into the legal and regulatory perimeter, legal certainty across all of Europe for stablecoins. Circle is the first company to comply with these regulations known as the Markets and Crypto Assets Framework. And I think it would be a miss, sincerely, if this merely becomes a digital twin of the underlying economy. It would be a miss if we let these types of innovations get co-opted by incumbents and established firms. If you were designing M-Pesa for the 21st century at world scale, you would use blockchain networks, which ledger transactions at scale for the speed and instantaneity of the internet for less than the carbon footprint of a basic internet search. That's truth one. It's mathematical, it's technological. The second is, the countries that are bringing these companies and regulations into scope are also building their industries. They're building developers. They're building, a value chain in which money can move more freely. And in many developing and emerging countries, foreign receipts through the course of remittances is a more important money flow than official development aid and foreign direct investment combined. And yet those money flows are stuck with monopolies or duopolies that have had zero competition. And so I would say watch what the advanced countries are doing and how they're regulating digital assets and bringing them into scope, and not what they say, because they've been heavy on criticisms, heavy on keeping this out of the perimeter, and mostly it's because of incumbent protection. Yeah. The banking lobby is a noisy lobby and a powerful one, and they don't want competition for how money moves. But this is the power of internet scale innovations, is at some stage you reach escape velocity. Enough people, and this is where in some ways it analogizes very nicely to decoupling telephony from fixed infrastructure. When I was with the former Kenyan governor of the central bank, he said, we were talking about the experience of COVID-19 in the United States. And he was like, well, we haven't sent a check in Kenya in more than a decade. Meanwhile, the domestic COVID response in the US was sending people a check. In a pandemic with quarantines, yes, a check is a liability, not an asset. And so digital money that is instant and arrives on your mobile phone, it's a powerful extension of financial access.
100%. I mean, all the conversations I've had on regulation in this space, I've always said, of course, you need some, but you need regulation that doesn't stifle. You need, creative regulations. You need regulation that enables. But as you say, is the protectionism is the problem? Is trying, the banks are powerful.
Well, and who are you protecting? With due respect, are you protecting the consumer, or are you protecting the incumbent? 100%. Telling consumers we're protecting you after a crypto crash is like a pilot telling you to put on your seatbelt after he had a bad landing. And so I think there's a bit more of a nuanced conversation to be had about the regulatory boundary, because we're also, frankly, in the case of the United Kingdom, we've been protecting the market and the consumers, but we've also been protecting the UK economy from job creation. These technologies are to money what Google is to search. These are critical, changing, technologies that are going to really radically transform financial access.
So actually, what brought me to trying to understand what is this space and really engaging has been the fact that at ODI we've done a lot of work on remittances and on counterterrorism for a long time. So when I was still doing research, which was a long time ago, I used to do a lot of research on the impact of counter-terror financing, particularly on remittances flows to Somalia and other places. And that's when I discovered the power and potential of blockchain. Actually, we also ODI was what encouraged or inspired a common friend, Elizabeth Rossiello, to set up BitPay, then became Asa Finance, because she saw the potential of using the blockchain, to remit money in a different way. So remittances are fundamental to so many low and middle income countries. They've seen a really strong period of growth in the past few years, and we know that they are continuing to grow. But the cost of sending money is really high.
Yeah.
Sending remittances, the global average cost is around 200 of sending $20 is around 6.4% at the moment, and that's more than double the SDG target of 3%. We know that digital remittances are more effective than non-digital methods. What's the role of stablecoin as a method of sending remittances?
Yeah, this is before the Libra project, I wrote an article for Forbes titled "Remittances: The Flywheel of the Global Economy." And in the case of a remittance, it's also very personal for me. I'm from the island of Puerto Rico. Yes, it's the territory of the United States. But if I want money to arrive on the island fast, despite the fact that both ends of the transactions are inside the US banking system, there's zero KYC question, there's no terror finance issue. If I want money to arrive in the island of Puerto Rico fast, I have to spend $30, and then I have to wait 3 to 5 days for the money to arrive. And so we don't have to go too far to see the problem with the way money moves. And I would analogize the pipes for how money moves are like your plumbing. Nobody cares until the toilet stops working or your sink is flooded. Then everybody becomes an expert in wanting to fix the plumbing. And so the pipes is the problem. And so USDC as a case study in remittances is powerful. The UN's SDGs number 3 calls for 3% by 2030. Guess what? When the United Nations needed to move money fast to Ukraine to support Ukrainian refugees, we were pleased to partner with the UNHCR and Stellar to build effectively an instant way of delivering digital cash to war-displaced refugees. In that case, the cost of the transmission was well below the 3% target. And the next piece of the puzzle is also really critical. It's the delay. If you need money now, none of the remittance pipes are satisfactory because they're less than instant. And frankly, most of the global payment networks are actually not payment networks, they're messaging networks, sending instructions of whose debit and credit goes where. And so it takes time. And guess who benefits from the delay? The institutions that are holding the cash. And float in global payments is like a drag coefficient on the global economy. So if you could free up money to work better, faster, cheaper, the scale of the internet, then you actually are not sending a cross-border payment. This is where the payments conversation starts to break down. You're sending an instant payment to a trusted recipient. And so the case study with the United Nations was able to deliver digital cash assistance into a very complex country with an active war zone with millions of displaced people, better, faster, cheaper than any alternative on the planet. But if we had just sent them a form of money that was trapped in a digital network and didn't speak with the real economy or wasn't entirely convertible, then there too, you have the sending somebody a liability, not an asset problem. And so the last mile fix there was to ensure, because of USDC's regulatory structure and broad bankability, that people were able to convert it into local currencies and cash in and cash out. So I think, this is the space where we're going to have the most disruption, is in cross-border payments and a lot of these really stranded ways of moving money. It analogizes almost perfectly to what happened when you broke away telephony and internet access from fixed infrastructure and from legacy operators.
Great. So you mentioned Ukraine. Obviously, countries that face conflict are often the places where you could benefit the most from the potential of this technology because of the challenges, the infrastructure and banking service. But these are also the places where the compliance regimes are
the hardest.
Totally. Particularly, I was mentioning Somalia before, a lot of this is imposed by the global north because of, anti-money laundering, combating the financing of terrorism regulations. And we work very closely with so many aid agencies. They've been hoping for a long time to, convert fiat currency into cryptocurrency or stablecoins because, in these places, that is what would work, but they're blocked by risk-averse banks. Even though, as we were discussing just before we started here, we know that, cryptocurrencies, digital currencies would offer greater transparency, greater accountability than, say, working through the Avala system that's been the traditional approach in these places. Do you have any examples of working in fragile and conflict-affected states at scale, so in a way that really can create a better sort of environment, to really send money at scale?
For sure. I think the best example of this question is Venezuela. In this instance, one person's censorship-resistant and sanction-resistant digital currency payment is another person's access to money that can't get taken away from them. One of the reasons I'm a big proponent of the pseudonymity and even, frankly, the anonymity of digital currency wallets is because in many countries around the world, the mere act of going to a MoneyGram or Western Union location puts you at risk. If you're a woman in the wrong country, picking up money in an inner city or urban environment or a rural environment, you're putting yourself in jeopardy to get the money in the first place. And so the notion that money can arrive on your phone that is entirely convertible in the real economy, that doesn't require you to subject yourself to identity theft and physical security risks, is a very powerful form of money. And remember what we're also replacing in the extreme humanitarian context. In Afghanistan, if you're flying aid into Afghanistan, you might be flying a pallet of physical cash to the Bagram Air Base. And so you've just landed with a honeypot for corruption, bribery, and fraud that is nothing short of a logistical nightmare. Now, I'm not suggesting that we stop sending cash to different places, but I am starting to suggest that maybe as public taxpayer-funded entities, the aid agencies of the world would be well served in doing things that are transparent and auditable from end to end. And so in Venezuela, Circle, together with AirTM and with other actors and the blessing of the Treasury Department and others, was able to send USDC to more than 60,000 doctors across the country for pandemic relief. At a time when one half of the country was being contested by the Maduro government and another half had the Guaido government and so on and so forth. And the point is, this good payment in a complex country, I won't say bad country because all countries are good, but they're just led by bad people. A good payment in a bad country can be executed at scale and give people a form of hard money that is entirely convertible in order to respond. I think this type of blueprint, the tech is the easy part. And shame on all of us if we're not able to scale this, both in humanitarian use cases and general competition for money movement around the world. It's entrenched interest, and it's people who would ultimately lose if this worked at scale don't want to see these technologies working. But that's a great case study with more than 60,000 doctors who benefited from that program.
Okay. And now that is included in the report you just released.
Yeah. And you know, maybe it's because I had a little bit of a vendetta when the Libra project was killed. To be able to show that these ideas, not only is it Circle's vision and mission statement to advance these use cases, but that it's not enough to just let the tech do the job. That you have to be pretty deliberate about sort of a social impact space race. And so we have a program called Circle Impact, led by Marcina, who's been on your stage before. We just took this conversation right to the United Nations this past UN General Assembly. And I wrote an article saying, look, the UN should embark on a technology optimism campaign. Because if we're telling the rest of the world you can't have the benefits of internet native money and financial services that don't take bank holidays, then I think we're also telling the rest of the world to stop developing. And so I think we could do better than that. So yes, we put out an impact report that highlights the exact examples that we're describing and more. And I think good things are coming.
Right. And for those who didn't fully appreciate the reference, Marcina Tillman has been on our podcast on Think Change in one of the episodes where we discussed the potential of cryptocurrencies in general, stablecoins, along with Carlo, who is here in the room, and Sheila Warren, who is one of our trustees of the Washington office. Just one last question for me. I want to open to the audience, both here and online. This summer, Circle became the first global stablecoin issuer to comply with the European Union landmark markets in crypto assets regulatory framework. Can you tell the audience about the significance of this and what is next for Circle?
Yeah. Happy to do that. Well, yes, indeed, the Europeans have done the unthinkable, something that the rest of the world has not yet done at the same scale, which was to ensure that digital assets are fully into the regulatory perimeter and afford the holders of these assets legal certainty. And they also give us what we have asked for a long time, which was, give us the pathway for legal certainty. We'll be the first to comply. So we're licensed out of France. In Europe, stablecoins are treated as electronic money. Both our digital dollar USDC and the digital euro that we have, EURC, are entirely compliant. And this is a common market of more than 441 million end users that enjoy passportability of these services across Europe. And I think to me, and we did this out of France. And so for anyone who thinks every crypto company is all about regulatory arbitrage, France is not exactly a jurisdiction you go if you're going to play around. And so for us, to me, that's just the beginning. What I hope MiCA enables and what I hope the Europeans enable, I've said publicly, MiCA, which is the Markets and Crypto Assets Frameworks, will be to digital assets what GDPR was to privacy. If we get it right, we set a floor. And if the world gets it right, we could then harmonize to that floor as opposed to a race to the bottom world. And the Europeans, in some ways, were the leaders in decoupling your mobile phone number from the clutches of the mobile phone provider. And if ever there was a chance to decouple the provision of very basic human right levels of financial service and financial access, it's this notion that digital money rendered on open source digital wallets and transacted on public infrastructure blockchains is also money that's portable to you and can't be taken away from you by a bank and is set in stone and set in law as a human right. And I think of that as sort of a good standard that we could argue for around the world with regulators and policymakers, but we can no longer put the genie back in the bottle.
I did say that was the last question, but then I thought, okay, you were here this week and there's a lot of interest about what the UK is going to do in this space, and without betraying any confidential conversation.
Sure.
What is
I don't want to be declared non grata in the United Kingdom.
No, we don't want you to be non grata here.
We have some elections coming up in the United States.
Yeah, you do.
So I'm not looking for political asylum. I'm just, keep my options open. So no, look, the United Kingdom is obviously a critical market in financial services, but over the last 5 years, it's also been a less than welcoming market in financial services. The former deputy governor of the central bank, John Cunliffe, wrote a speech or gave a speech in which he referred to my prior project as black ships on the horizon. And so my hope as one of the captains of those ships is that one day we are able to now find safe harbor in the United Kingdom, in part because I think it would be a very powerful upgrade of not only the fundamental technology that banks and non-banks and others in the UK can leverage, but I think it's a fundamental upgrade as well in what the large population of people in the United Kingdom that are parts of diaspora populations or send money around the world to their friends and family can also benefit from these innovations in the domestic payment system. And in the end, if we get all of this right, you'll never once have to use the words crypto and blockchain and all the jargon because the tech is fading into the background. And so there isn't a large financial institution on the planet that isn't thinking about how to use this infrastructure. Cloud computing was terrifying in the beginning, and IT teams had job preservation on the line if they gave up their direct management of server farms. Cloud computing today, essential global critical infrastructure for public and private use. And I think blockchains are in the same journey.
Agreed. Let me open to the audience, both here and online. Questions are already coming. Kahal, yes, of course. Introduce yourself as you take the floor.
Hi, I'm Cathal. I'm a senior research fellow here. Thanks, Dante. That was super interesting. I've got loads of questions, but I'll start with this one. You talked about people in lower income countries being able to be brought into the formal economy. What about people in lower income countries who want to stay in the informal economy, at least for now, but would like to transact digitally because it's more useful for them? What's in it for them?
Yeah, that's a great question. Well, first, I think most of the actual use cases of dollar stablecoins is not really payments yet. It's actually store of value use cases. So when we look at our own data on USDC, we find that a big percentage of it, up to 70% or more, is held off of crypto exchanges and on externally owned wallet addresses. And obviously, we're a wholesale company, so we don't know the identity necessarily of every single end user in the world. And that, again, that presumption of privacy in your financial life is a feature, not a bug. But most of those use cases are not necessarily directly correlated to payment activity and cross-border payments and remittances yet. Those are the green shoots. It's actually store of value, a hedge against inflationary domestic currencies and a store of value. And so I think that's, in my mind, the sort of step one of basic financial access is a form of currency in which you could store value and preserve it. Step two, obviously, is the other features of programmable, composable digital money are actually all of the credit, lending, and other markets activities that can happen in sort of the ladder of money. So stable coins are unique compared to all other forms of money because they're composable and programmable. And so if you want a zero default loan, you could set that in code, and then you could ensure that a loan that you facilitated using stablecoins is always paid automatically to two different counterparties. That's what is known as DeFi, decentralized finance, effectively is software intermediated capital markets and lending activity. Super powerful set of use cases being unlocked there. And stablecoins are the digital thrift that make that possible.
Thank you very much. How does a stable coin like USDD compares with initiative that central banks are increasingly looking in terms of creating their own digital currency? How do you contrast the two?
Yeah, well, as it happens, I have a long paper on the topic titled "The Case Against Central Bank Digital Currencies," but it's not so black and white. There's huge differences. First of all, no serious central bank has yet fully produced a central bank digital currency. Western central banks, including obviously the Bank of England, are contemplating this. I even wrote parliamentary evidence for the hearings here in the UK on central bank digital currencies. There's some important differences. Number one, they don't broadly exist, central bank digital currencies. Number two, they're not likely to circulate in this open peer-to-peer manner. They're most likely to be wholesale innovations and intermediated by wholesale banks. And so those efficiencies should be sought after in the bank-to-bank, in the central bank-to-bank relationship. But if you want money that is extendable well past your borders, then I would argue that a central bank digital currency construct, even in a very well-meaning country with benign intent, is most likely to be an intranet or an extranet of value with super permissioned networks of participants. In fact, Agustin Carstens, the general manager of the Bank for International Settlements, has coined this term with Nandan Nilekani called the Finternet. But still, it would be this permission network of institutional counterparties trying to trade liabilities among each other. I think of stablecoins as the internet of value, in part because they already have escape velocity. Just USDC has processed more than $16 trillion of cumulative payments over 5 years. And we've done so at 200 country level scale. And so the key, though, is to ensure that there's complete interoperability of these digital money innovations, which is why if you claim you're a digital dollar, you actually need to be backed by dollars, and you actually need to survive what I call the Jerry Maguire test, show me the money. And the history has taught us up until now that most of these early products have not passed that test, which is why regulators and others have been reluctant to pull crypto into the perimeter.
Let me take one question from the online audience, and to be fair to them as well, and actually also to encourage the online audience to put their names, so I know that who the questions are from, because this one is anonymous. I understand that ARTM for Venezuela obtained a special OFAC license. Getting a special license is difficult. Many jurisdictions have general license from OFAC, but this can be insufficient for banks' risk appetite. How can we do this at scale without special licenses for every case?
It's a great question. I don't know if that was Sheila asking anonymously.
It's not. Could be.
It's a great question. I mean, frankly, part of what I think we're offering and why we're so meticulous in documenting these case studies is actually an opportunity for the governments of the world to lift the restrictions that are holding countries back. If you care about a poverty alleviation agenda, and frankly, if you also care about the geostrategic nature of competition and dollarization and de-dollarization trends, then my own public testimony to Congress on how to respond, for example, to climate change in Africa is to actually revisit entirely this idea that we're going to hold the population of a country accountable for the misdeeds of the government. It just doesn't work. And that's like saying, you shouldn't be able to use WhatsApp because you live in a country with a terrible leader. Let's hold the leaders accountable and not people accountable. And financial access is a human right. That doesn't mean that you ignore OFAC. Quite to the contrary, we've demonstrated as a company when OFAC sanctioned a crypto mixer known as Tornado Cash, Circle complied. Where the rest of the crypto industry went silent, I put my name out there and said, look, let's not let good technologies get co-opted by bad actors. Let's not pretend the laws don't exist. But dear OFAC and others, please revisit this brute force instrument unless you want to see the acceleration of de-dollarization in many countries around the world.
Great answer. Let me take another one from the online, then I'll come to you. Carlos Pena is asking, trust in financial institutions is often fragile. What are the most important aspects of Circle's strategy for maintaining and deepening trust with regulators, institutions, and users?
Carlos is one of the smartest minds, so he probably has all the answers that I would give, if not better ones. So, number one, it's one, we have personhood is the way I've dealt with it. Both as the witness in the hot seat and in today's hot seat, but it's also about, getting to the best levels of regulatory clarity you could achieve, and then operating on the basis of demonstrating that financial inclusion, financial innovation, and financial integrity are not trade-offs. And I think that's why these humanitarian projects and these pilot projects work. No one wants to be a first mover with anything, but the treasurer of the UNHCR, Carmen Het, is a great example of a first mover advantage that then ought to destigmatize the next person in line from trying something new. And so we've tried to chronicle the experience of these first movers, these humanitarian use cases, to enable the next person to get an 80% solution that's nearly fully baked and then tailor it to their business model. This is also the place where if you want to modify OFAC rules, I've had meetings with OFAC where the counterparty bank is the slow-moving party, not the aid agency, not the implementing partner. And so this is where I believe very fundamentally in this idea of Nothing worth doing is worth doing alone. And if you want to really prove what this can do, you need to build some uncommon coalitions and then lobby together to the Treasury Department, to OFAC, to the State Department and others to say, look, I think we could do this much better than cash at the airport that goes completely opaque and unaccounted for.
100%. That's exactly why I wanted this conversation here, because it's part of creating this coalition, because in reality, there are so many colleagues in humanitarian development world that really don't understand the technology, the potential. And so building the coalition is predicated on making sure that the potential allies understand and come on board.
Yeah.
But let me go to Hans-Peter.
Yes. Hi, Hans-Peter Lanks here with ODI. I have two questions, two quick ones, I hope. One is, I'm afraid, sort of an age-related question. So I cannot but notice that the average age in this room is well below what we typically have. And that is, you've kind of been using digital currencies, money transfer, digital money transfers, cryptocurrencies interchangeably in this discussion.
Yeah.
Maybe I didn't get that. But are they actually interchangeable? So for instance, when I use PayPal for a payment, or Zelle across borders, why do I need crypto? What's sort of the step between those two and these features that money has, these characteristics that money has? Why do we need to go all the way to have a cryptocurrency?
Great question.
The second question is stablecoin. Money that is anchored in a value, be it gold or the dollar or whatever else, has to be managed. So there's a central bank that then sort of manages it with reserves and interest rates and other things to try to keep that value. Who has that role with stablecoin?
Great question. Let me answer the first one, since both of us are probably going to date ourselves. That for some of us, the money we use has the words "In God We Trust" enshrined in it, and whatever equivalents are emblazoned in UK physical cash. But what you're moving when you're moving money on PayPal is the message to debit and credit to balance sheets. And so you don't have settlement finality instantly. In fact, you have a wait. And the big payments companies around the world offset the wait by using the balance sheets that they have in both sides of the transaction. But guess what? PayPal owns Venmo, but a Venmo user can't pay a PayPal user simply because the rails don't speak to each other. And that, I mean, this is a very old analogy, but I'll give it. It's like having Gmail not be able to send an email to a Hotmail, not be able to send an email to odi.org. And the only reason email works as a genuine open global network is because the protocol for how email is sent is universally accessible. And so blockchain rails are open, universally accessible protocols for moving money, but not just money, storing and ledgering any other critical asset that has a long shelf life or value. So that hopefully explains part of the difference. The monetary policy question. If you're a proper stablecoin, as I think we are, don't take me for it, it's the regulatory world that tells me I'm good, then you're entirely responsive to the monetary policy of the underlying currency that you reference. And so if we had a monetary policy at Circle, and we would create USDC out of thin air, and it would then be an inflationary or deflationary currency. We don't have any monetary policy. USDC is demand-driven. And if demand grows, the circulation grows. If demand shrinks, circulation shrinks. And ironically, if the underlying economy has a cold or sneezes, Circle catches a cold. We're totally responsive to US monetary policy, which is why we actually set our global headquarters at the top of One World Trade Center in New York. We don't want to build the next 100 years of digital dollars in the crypto shadows. We think this is critical to the heart of finance, and entirely responsive to monetary policy.
Let me go. Oh, I have a ton online as well. Let's see what we can get to. So you said, as a follow-up question, that digital currency have the potential to be fairer to the unbanked. And there's another anonymous question that asks, how can they help? Given the digital divide and levels of poverty, can you please elaborate on how you can reach those most in need?
It's such a critical question. My analogy for this type of question is, you remember back in the early days of development, people would say, if people would just wash their hands, we can stop the spread of communicable diseases. The presumption is access to clean water. And so the like layers, the step zero problem in the digital divide is basic access to technology, internet connected technology. So I acknowledge, and that's why we have a digital financial literacy initiative. That's why we have a Circle Impact program. That's why we're trying to partner with aid agencies and have conversations like these, is that the last mile issue we can't solve on our own. But what we can demonstrate is the actual barrier to entry to serving billions more people than we're serving today is now no longer an excuse. I'm the first to tell you, technology alone is not a panacea for the world's problems, but in our case, and in many cases, it often shows where status quo is falling short. And so like the idea that, well, I don't know how to reach 100 million people more with mobile enabled money. It's not the tech, it's the entrenchment. Absolutely. It's the fear of change. It's not the tech. Yeah. But this idea, this really critical question of accountability, digital literacy, financial literacy are all sidecar demands. But the more we can scale, the more you could actually ensure that the access is ubiquitous as well to the critical information people need to know what they're getting into. Because crypto, blockchain, stablecoins, they're not all created equal. The terms of art are not actually interchangeable. And we do have to provide better education to the world and the market about good and bad.
100%. I saw more hands, that gentleman here.
My question is something very similar to the last questions,
Can you
I
introduce
guess.
yourself?
Sorry, I'm Ajay Nandakumar. I'm not working at ODI, but would love to work. Yeah.
So Sarah, we met in the lobby.
Oh, okay.
He needs an internship here.
I would like to explain. So my question is, what's the effectiveness of monetary policy by the central bank on controlling the money flow, the cash flow, basically in the market, when you have decentralized finance like this?
Yeah.
Like, what's the actual effect? Like, will it be effective in controlling the cash flow when you have DeFi like cryptocurrencies, basically? So yeah, something like this.
It's a great question. So it's sort of back to the why are banks afraid of these innovations getting big? It's because of a fear of a flight of deposits from the banking system. Why are central banks afraid of any of these innovations getting big? It's for a fear of the erosion of monetary sovereignty and monetary policy. Guess what? The very first of the global rules in digital assets to be harmonized as early as 2016 was the travel rule. Recommendation 16 by the Financial Action Task Force, which showed that any two transactions or any transactions to any 2 points or wallets of any crypto asset required beneficiary information to travel with it. And so not surprisingly, many countries around the world, Brazil, Argentina, many countries around the world are now starting to regulate the virtual asset service provider, which is the wallet. The wallet provider coming into scope from a regulatory point of view ensures that at all times, if you want a neck to choke, you have one. And if at all times you want to continue to assert capital controls and other issues, you have the way to do it. What you're getting rid of, though, in a stablecoin denominated payment into a developing or emerging country is the cost of the money getting into the country going to a MoneyGram or a Western Union. You're getting rid of the friction. So hard money receipts that reach end users is a big, I mean, think of just purchasing power parity of hard currencies arriving in many countries beneath the corruption threshold and beneath the friction threshold of these international money movement networks. It's a powerful driver of economic development, but it should be subject to, of course, the monetary policy rules of those countries and not distort them. So I think, frankly, when people talk about digital dollarization or the crypto transition of whole economies, it's a little bit generous of the power that these innovations have on their own. They need to work within the boundaries of policy.
Wait, yes.
Hi, I'm Bianca Gatzel. I'm a researcher at ODI. And I'm going to press on this point, so apologies.
That's okay.
But in regards to what you just said, there's a discrepancy between the emerging markets that do have regulation for this and those that don't. And we see that, as you said at the very beginning, regulatory adoption for this is higher in advanced economies, but the adoption of the cryptocurrencies themselves tends to be higher in emerging markets and developing economies. So living within that dichotomy, how do we deal with the fact that there is going to be this monetary policy issue that emerging markets and mostly developing economies are going to suffer from if effectively they have to capital outflow to back these reserve assets that are custodied in the US or whatever other hard currency. So while these countries that are most volatile to any local currency movements, that have weak monetary policies, how do we engage with them to ensure that we're able to increase their financial access through crypto assets, but at the same time ensure that we don't distort policies that are too anew in these markets? Thank you.
Yeah, it's a phenomenal question. And not to be cheeky with my response, I think part of the answer is, you know, the very first few things that were censored on the internet was content production. And, you know, even in the West, you needed licenses to publish a website. And the publisher's first response was, let me erect a subscription firewall before you could access this new tool that would democratize information and so on. And so I think in the end, digital assets will circulate as freely and as ubiquitously as people have used WhatsApp to send messages. And there, at some level, is not much we can do about stopping that. In the same way that the dollar as a global reserve currency and the dollar as a hard currency enjoys these post-World War II oddities in its circulation and its trust, the dollar is the general reserve currency of digital assets as well. And the fact is, you know, despite capital controls and despite these issues, I think many people who are the early adopters of digital assets and crypto are in part choosing the political economy they want to be a part of with their phones, and opting out, unfortunately, of some of the harder regimes that they exist in. And so my recommendation to emerging country finance ministers and central bank governors is pull this into the perimeter, create rules for virtual asset service providers to exist, because one critical distinction, why this is known as Web 3, Web 1 and 2, all the value went into Silicon Valley, into single postal codes. Web 3, read, write, own, and literally today, Circle is a developer-first company. We have developers all over the world building locally enabled on and off ramps for USDC that in the end will build jobs in countries and create entrepreneurs. If you're just the beneficiary of a low-cost payment, then it's transactional. If you're the creator of a vehicle and a wallet and a company that localizes this experience in a country, Hisab Pay in Afghanistan is a great case in point, then you're an entrepreneur, then you're creating jobs. And so I don't know if the answer is so black and white. It's more nuanced, but what we are clearly provoking, post-Libra, 114 central banks around the world now have a digital currency conversation at least. It's a good thing, because they're looking at themselves in the mirror going, what's wrong with my system? If we had a monopoly on moving money, but one project with a white paper was sufficient to scare us, what's wrong with the way we move money today?
We're almost at time. Let me take one last one from online, unless there's any other desperate question here. Is from Phyllis Papadevi. She asks, your predictions on the relationship between stablecoins and digital central bank currencies. How will this relation influence monetary policy mandates in the future?
Sure. First of all, I think these products, as constructs, at least notionally, are completely complementary. And so this gets to the like money substitution, balance sheet substitution question. At some level in the development agenda, we're merely robbing Peter to pay Paul if all we're doing is talking about who will build the better digital currency mousetrap. We've got one that works. It works at scale. We're being deliberate about using it and pointing it to really serious humanitarian issues. And so I think these innovations at scale will eventually converge. In the same way that cloud computing went from fringe technology to the core of technology, and every country and every public and private organization uses it. My sincere hope is that we destigmatize crypto, we get smart about it. And my sincere hope is that what we can show is that we can go places where money cannot go, public or private, if it remains the domain of the well-heeled, and if it remains the domain of brick and mortar banking. And so I think breaking free a little bit can't hurt us. And if we don't do anything, I think we're actually in bigger trouble than if we do a little bit and take some calculated risks.
Dante, thank you so much. It's exactly the conversation I was hoping we would have. We've had this conversation in many other circles, you know, usually in closed-door roundtables. I really wanted to have a public conversation around these issues, particularly, you know, through ODIs stage, because we reach a lot of those people that should be part of this coalition for change, should be part of, thinking differently. I don't know how many conversations I've had over the years about innovative financing, innovative ways to get money to places, innovative this and that. And then when the innovation is there, the immediate reaction is, oh gosh, this is too complicated. Oh no, this is too risky. Oh, this is a problem. And instead, we should invest in understanding, leveraging, using it. And I really, really hope that, we can continue to build on this conversation to create these alliances that you talk about, because the ultimate goal is shared, and it is, to really increase the access to financing for the people that don't have it, increase the ability to remit money more cheaply. It is, to support those in emerging markets, but also, quite frankly, a lot of people here who are unbanked and need access to financial services. Thank you so much for being with us. Thank you for giving us time at the end of your trip to the UK. I'll probably see you again in Washington next week. But thank you to the online audience, the audience here in the room. But please all join me in thanking Dante Disparte very much for joining us tonight.
Thank you.